Alright guys, so let's talk about America's upcoming trade deals. Now this is very important on so many fronts. For one, it gives us insight into how far will Trump go all the way to win his tariff war. Now to the US, friend and foe, they are fair game. It's all about bringing industry and jobs back to the US. The agenda is the agenda and everything's topsy-turvy. Trump will try his darnest to bring US trading partners to heel. And in this case, Japan is facing the tariff firing squad. In Trump's non tariff cheating list, the first point is a warning not just to China, but to the Japanese as well. The US has long regarded the yen as being too cheap and Japan suppressing their currency for a long time. And this was to be expected. Japan is in a horrible debt crisis, and until recently, they were on endless yield curve control. The Bank of Japan was buying a ton of bonds to prevent rates from going up. Peasant wants to prevent that from happening again. Now the plan is to ensure the yen keeps strengthening against the dollar to help American exports become more competitive. But how much more does Washington want Japan's currency to strengthen? Thanks to the crazy trade war, Japan's yen has been appreciating non-stop ever since Trump's inauguration. We have gone from nearly 160 to the dollar to reaching below 140 in an epic bull run for the yen. Now this sounds great for importers and savers in Japan. Their buying power increases and combats imported inflation. But here's the flip side. As the yen continues to strengthen, this makes Japanese goods more expensive, which is a double whammy for exporters. Not only do they face a wall of tariffs from the US, the rising yen is hammering US consumer demand even further. Beyond just the US, the global economy is slowing down, so consumers everywhere want value, and a 10% rise in price is enough to turn people off. Japanese exporters are also facing Chinese competition, which is extremely fierce. The export numbers are clearly signaling a crisis ahead. Japan's export growth in March declined to 3.9%. This was down from February's 11.4% jump and the market consensus of 4.4%. Here's the problem, much data does not include the impact of Trump's auto tariff yet. Digging deeper into the numbers, we realize that US restrictions on Japanese exports, they are taking a big toll on their industries. Remember Biden's curbs on semiconductors made by US allies? Well, that punishment on China is now punishing Japan's overall export economy. Their overall exports to China fell by nearly 5%. And guess where the collapse came from? Semiconductors and chip makers to China. It's not that Beijing didn't want to buy or they didn't have the money to import from Japan. It was because of US orders. Japan obeyed and now their exports to China they are collapsing. And now the meeting with Scott Bessent is looming. Will Bessent show mercy to the Japanese yen? And can Tokyo even afford to obey the Americans for tariff concessions? Now you would think that there would be a deal that could be worked out, but it seems even Japan has their limits. Their entire economy is on the edge of a cliff with very little wiggle room. Japan sees little scope for a grand currency deal with the US, and if Trump was hoping for Plaza Accord 2.0, he might get sorely disappointed. He might get nothing at all. Tokyo just doesn't have the room to make the shift. Japan is boxed in. Now, Washington definitely doesn't want them to dump T-bills and bonds to buy back the yen. It would hurt the US debt market, which is in emergency mode. And trying to use monetary policy also isn't the answer. Considering Japan's debt level, this would most definitely trigger a bigger debt crisis. Their interest payments alone are approaching 10% of government revenue. And if rates go higher, it deals a double whammy to the national debt. Exports will suffer, so government revenue will drop. Borrowing costs in Japan will also reduce growth, and either way is a disaster to raise rates. But Citigroup still believes the US will arm twist Japan. They believe Besant has a target of $1 to 100 yen. Even if a compromise is reached at 120 to the dollar, this will still be damaging to Japan. We are at 140 today. To get from here to 120, it would mean a 15% revaluation higher. That would mean Japanese goods become 15% more expensive for global importers. Can Japan afford a further hit to their exports, even if the US allows Tokyo to sell treasury bonds to pop up the yen? This will make Japanese goods even more uncompetitive. And it seems the problem isn't with Japan, it's with Washington. Negotiators are complaining that the Americans simply can't make up their mind. They keep changing their asking terms, and we have no reason to doubt their statements. Trump has flipped so many times on the tariffs. They are on and off, and then they are off and on. Even if you can reach a currency deal, both sides will still suffer greatly. These are the real world constraints of the trade war. Japan will have to fall on a sword again, they might have to do it, while the US might have to sacrifice their treasury market in the process. And at this point, can the US bond market endure another hit? Japan dumping their holdings will jack borrowing costs across the board for US companies as well. And every tangible metric in the US markets is not looking good, and all that has consequences on the real economy. Everything today is interconnected. The value of stocks have plummeted by 10 to 15%, not as severe as the pandemic or the GFC in 2008, but still very significant. And this creates the reverse wealth effect, where people feel poorer as their net worth collapses. As a result, they will start to spend less. Meanwhile, US bond yields have climbed by over 10%, while the dollar has collapsed by over 10%. It's the complete opposite versus the previous two crises where bond yields dropped and the dollar strengthened. So in 2025, personal and corporate loans in the US will be more expensive. If you want to import goods for production or simply consume, buy stuff for yourself, you'll have to pay 10% more as well. This just creates a self fulfilling prophecy of a recession. Normally, trust in the US and confidence in the dollar allows America to weather the storm better than any country, but things have changed. While the White House continues to deny that a recession is coming, global money managers are disagreeing, and these are people who can't afford to be wrong when it comes to the economy, and they aren't buying what the dream team is trying to sell. We know investing our money is essential, but the best investment is monetizing a skill or business plan that you have. And that's where you truly have unlimited upside to build your dream life. Now, I started out as an employee before going freelance and now operating my own business. The ability to control my own hours is priceless. And I want the same for you. Starting a business remotely in Singapore and Hong Kong is one of the best decisions you can make. And with Osome incorporation in these tax-friendly regions has never been easier. Enjoy the benefits of doing business in these metropolitan cities with the tax advantages wherever you are in the world. The process is hassle-free and completely paperless. Osome will handle your financial administration, taxes, bookkeeping, and accounting. Best of all, with Osome's easy-to-use platform, you can track your cash flow in real time and stay on top of all those invoices. It's time to manage all your business finances in one single place. No need for multiple apps or tools. Focus on delivering value to your customers and creating new awesome products. So free up your time and get your business off the ground in Hong Kong and Singapore with Osome. Get started today and build a business that really matters. Incorporating in Hong Kong or Singapore? Click the link in the description or pinned comment below for 16% off any Osome services. Let's start your business journey today. Apollo Global Management, who has $750 billion under management, they are sounding the alarm bells. There's now a 90% chance of a recession if Trump's trade policies remain. They call it a voluntary trade reset recession. But if you ask me, a fire is still a fire. You still get burned. The tariffs will impact small businesses disproportionately. These enterprises will have to eat the tariffs, which means either a profit collapse or outright closure of the business. And either way, people, they're going to lose their jobs the longer the trade war drags on. Now, in the previous video, we talked about the micro impacts, especially on individual business owners, how real businesses are getting hammered. But let's zoom out today and take a look from the macro perspective. Thanks to the tariffs, orders from overseas suppliers will be sitting in warehouses or just outright cancelled, especially if the supplier is Chinese. Which company can afford to pay 145% or more in tariffs? Between the final week of March and week 1 in April, US import bookings collapsed by 64%. A ton of goods bound for the US were simply cancelled. Importers are not bringing in the cargoes because they aren't viable anymore. And a big part of those imports were bound for small businesses. Their business models are now forever broken. And when you are broke and the future is uncertain, The last thing you would do as a business is to reinvest back in. And according to Apollo, small businesses in the US accounts for 85% of total capex in the economy, and that's capital expenditure. That's more than 5 times the spending of the S&P mega companies. These are enterprises that are more vulnerable. They don't have the financial buffers or big lines of credit to get them through the crisis. Many of them are in fact just living from month to month or just breaking even. This might be the end of the era of the US being exceptional, and it's not me who's calling for it. It's yet another global bang that's screaming into the wall. The global rotation out of American assets won't just last for weeks or months, it could continue on for years. And that obviously means more downside for US stocks, more downside for US bonds, and the dollar cratering even further. And if we compare where the S&P stands with even EU stocks, we can see where capital flows might head to. Apart from the US and China, Europe has the third biggest equity market in the world. And considering their PE ratios, we can see the S&P 500 correcting down to the average price to earnings of 17. EU stocks, however, haven't been moving much since 2021. And if this global rebalancing or global rotation happens, we could see money leave US assets and pile into places like China and even Europe. We have to consider the macro situation of economies outside of the US to really get a clearer picture here. Now, while Trump wants to cut the deficit and the trade war is hammering down US consumer demand, the rest of the world is actually spending more. The EU is dismantling their debt limits while China's stimulus is not going to stop. China's GDP growth came in at 5.4% in Q1, and if they inject enough money, they could actually hit 5% for the whole of 2025, despite what's going on now. We are in a situation where the US economy is hurting more than the world, and this is really unprecedented. China's trade surplus also paints a very interesting picture for us. It confirms two critical perspectives in the new multipolar world. Firstly, China's trade with the world is still going strong. Their trade surplus is still at a record level, over $270 billion in Q1 this year. But look at the contribution. Their surplus from US trade is dropping, but their earnings from the rest of the world, those are climbing. And it tells us that countries outside the US are still spending and that affordable goods are more important than ever before. Pivoting to the US economy, the damage has already been done to the consumer, and we have to brace for impact. The Institute of International Finance has a warning for us all. The US economy will likely enter a recession in 2025. In Q3, GDP will crash by 0.8%, while in Q4, the contraction could be 0.3%. And this quarter, the Atlanta Fed's latest estimate is negative 2.2%. So by July, we could already be in an official recession. Two other numbers stand out that paint a very important story. Core inflation will rise from 2.8% today to 4.6% by the end of the year. So it does seem that tariff raised prices, who would have guessed? Growth next year in 2026 would only hit 0.8%. That's not impressive at all, especially when Besser keeps saying China is collapsing at a 5% growth rate. But hey, maybe we are all wrong. Maybe you and me, we are the delusional ones. Maybe the brightest bulb in the White House will be right in the months ahead.
Going to see leadership that this country is missing, and this is going to be an economy that is explosive. So you're worried about someone pre-announcing? What they should announce is in the fourth quarter of 2025, this economy is going to be humming.
But as always, let me know what you think. Can Japan dodge the US currency demand? And is there any way for the US to escape a recession? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.